Sumitomo Corporation makes money through a highly diversified global business model, acting as an integrated trading and investment company across sectors like metals, transportation, infrastructure, media, digital, chemicals, energy, and real estate. Its core strategy involves identifying new value, trading commodities, products, and investing in long-term growth. Generating income from large-scale projects, logistics, resource development, and digital services. Sumitomo Corporation showed strong earnings growth from 2017 to 2025, with impressive recent surges, driven by strategic gains in real estate and IT, though facing some sector challenges, signaling a positive trend despite market complexities. Sumitomo's profits, particularly for Sumitomo Rubber Industries, dropped in 2021 due to rising raw material costs, higher freight expenses, tough competition, especially from China, and impacts from US tariffs. Even as they saw strong premium tire sales and tried cost-cutting measures like closing a US plant to offset losses and improve future outlook. The diversified Sumitomo Corporation also faced pressures from its fossil fuel businesses and project delays, leading to a downward earnings forecast. Though they focused on portfolio shifts towards renewables and other growth areas. In May 2021, Sumitomo launched Shift 2023, focusing on portfolio restructuring, exiting low-profit areas, and building resilience against future shocks. Sumitomo Corporation turned to profit by leveraging strong performance in key areas like tubular products, construction equipment, real estate, and digital businesses, while strategically managing declines in other sectors, implementing growth investments, and benefiting from yen depreciation. They focused on restructuring, acquiring high-value assets, and showed strong progress in their medium-term plan towards record profits in FY 2024-2025, despite past challenges like the Ambatavi nickel project losses. In terms of the balance sheet, it maintains healthy balance sheets with solid equity, manageable debt levels, low debt-to-equity ratios, and strong liquidity, indicating financial stability. For example, Sumitomo Corp showed a healthy shareholder equity ratio of over 30% and manageable debt as of early 2025. Sumitomo Corporation boosts retained earnings even with profit dips through smart asset portfolio management, selling low-profit assets, investing in high-growth areas like DX, GX, healthcare, focusing on cash flow efficiency, disciplined capital allocation, share buybacks, dividends, and strategic divestments, all guided by medium-term plans to ensure financial soundness and sustainable growth, not just short-term profit spikes. Sumitomo Corporation increased shareholder equity primarily through retained earnings from strong profitability, ROE greater than 10%. Disciplined capital management focusing on positive free cash flow after returns, strategic investments in growth areas, DX, energy, and efficient management of liabilities, all while returning cash to shareholders via dividends and buybacks, balancing growth with financial soundness as per their Shift 2023 and Medium-Term Management Plan 2026. Sumitomo Corporation's cash flow is robust, driven by strong core business earnings, asset sales, like cross-shareholdings, and strategic investments. With significant positive operating cash flow and sizable free cash flow, though net free cash flow can vary as they reinvest heavily into growth areas like digital, ICT, and shareholder returns. Aiming for sustained value creation. Sumitomo Corporation's debt-to-equity ratio varies slightly by source and period, but recent figures show it around 0.74x for recent quarters, e.g., September 2025. With some annual data around 0.81x, indicating good financial health as they aim to reduce it further, showing decreasing leverage over time from levels like 0.9x or 1.0x. Sumitomo's timing for share buybacks, started in 2023, often seen later than peers, started in 2021, stems from a focus on strategic investments in new growth areas, like digital, green energy. Prioritizing portfolio restructuring, like divesting non-core assets, maintaining strong cash flow for opportunities. And a Japanese corporate culture that traditionally favored internal reinvestment or dividends over aggressive buybacks, though this is evolving. They often use buybacks to signal confidence or optimize capital after significant strategic shifts, rather than preemptively. As seen with recent deals to secure full ownership in subsidiaries and repositioning.